Over the past year, Enphase is down by 43% and is currently trading at $66.74, which is more than 50% lower than what they have been trading at their 52-week high. So jumping straight to our stock valuation spreadsheet, I have already plugged in the ticker for Enphase, and right away we can see that the company currently doesn't pay out any dividends whatsoever. And this makes me quite happy, as it means that they can push most of their free cash flow into innovation. And with rising tariffs, they can also use it to try and keep their profit margin nice and high. Now you can also see that they are about to announce their Q4 earnings on February the 4th. So should you buy the company before the earnings call? Well, jumping to our 9-pillar analysis, we can see that they get a rating of 5 out of 9 with 3 pillars currently in the red. But first, let's direct our attention to the growth of the company. Their 5-year revenue CAGR is sitting at 24.8%, their 5-year free cash flow CAGR is sitting at 56.89%, and their 5-year net income CAGR is sitting at 43.84%. Now, if we have a close look at the profits growth, we can see that year over year the revenue fell by a lot, the net income fell by a lot as well, and the free cash flow fell by a lot as well. And this is one of the reasons why the company has been falling in price in 2024. Now, you would think that with the company falling in price, their PE ratio would be sitting nice and low. Their 5-year PE ratio is actually sitting at 92.51, and if we have a closer look at Pillar 1, their current PE ratio is sitting at 151.68. Now, the reason why this doesn't bother me is because, as we know, the revenue and the net income of the company fell by a lot. So if we scroll down, we can see that in 2024 the earnings per share was sitting at about 3, but currently with the fall in net income, it is sitting at only 0.44. So if we do some quick math and take the current trading price of the company sitting at about 66 and divide by the 2024 earnings per share, we get a PE ratio of only 22. And as I do believe that the company's earnings will quickly recover, calculating this PE ratio makes me believe that the company is currently trading undervalued compared to their earnings. And actually, if we jump to the second pillar and look at the price to free cash flow of the company, we can see that currently their price to free cash flow is sitting at only 16.32, so they are also trading undervalued compared to the free cash flow they generate, even though it fell a lot year over year. But now let's jump back to the 9 pillars and have a look at some of the other pillars. We can see that Enphase has been increasing their shares outstanding at quite a low rate, so this doesn't bother me that much. Their 5-year profit margin is sitting at 17.97, but if we have a close look at pillar 6, we can see that currently it is sitting at only 4.91. So I would keep an eye out for the 5-year profit margin, especially with the tariffs to increase. But now let's also have a look at the 9th pillar, the long-term liabilities of the 5-year free cash flow, which is sitting at only 0.74, and means that with the free cash flow they currently generate, Enphase would be able to pay off all their long-term liabilities without an issue. So now that we have gone through the 9-pillar analysis, let's calculate the intrinsic value of the company. So jumping to our grams formula revised, after plugging in the 5-year earnings growth estimate at 21.62% yearly over the next 5 years, we will get an intrinsic value of almost $70. Now jumping to the second valuation model and plugging in the free cash flow over the past 5 years, calculating growth rate into the future of 15.7%, we will get an intrinsic value of $121.16. Now for the third valuation model, I will compare Enphase to 2 of its competitors, plug in the 5-year average earnings per share instead of the current earnings per share, and this will give us an intrinsic value of $92.31. And finally, we will skip the dividend discount model and arrive straight to the ultimate valuation, where we will average out the 3 valuation models and get an ultimate intrinsic value of $94.26, which is 41% higher than the current trading price, and with a margin of safety of 30%, we would get an acceptable buy price very close to the current trading price of the company.